Yeah, so we'll look at the dividend yield, which is basically just like the return each shareholder is getting, right? This is the formula here. It is dividend per share over market price per share. Okay, so you can think of it like this. You pay market price of a share, let's say is 10 kwacha. So you pay 10 kwacha for that share. And let's say you pay 10 kwacha for the share by paying the market price. Then let's say you earn 4 kwacha as a dividend. Okay, dividend per share, you get 4 kwacha as a dividend. So you're just trying to find out, okay, so what is my return? All right, so 4 over 10, 0.4. 0.4 times 100, that is a 40% return. Okay, colleagues, that is I think dividend yield, the return that you are getting as a shareholder. Okay, any questions? All right. So even this one, if a company is giving a higher dividend yield, the better. Okay. Let's say, for example, if the dividend yield for butter is let's say 5%, and the dividend yield for Shoprite is 1%, then you're better off investing in butter. Okay. Or butter is doing better that year. All right. Yes. Okay, the dividend payout ratio. Basically, what this ratio is just telling us that out of the net profit the company has got, what percentage is going out to pay dividends? Okay. Out of the profit that the company is getting, right? What percentage is going to shareholders? All right. As you can see here, the two formulae: dividend per share over earnings per share. Okay, if you want to look at it in a single format, remember earnings per share is what if the company distributes all the profits, how much each shareholder is going to get. Then the dividend per share is how much you get for each dividend. All right. So this is one formula you can use. The other one is ordinary dividends, the money that needs to be paid out to the shareholders, over the profit available to the shareholders. Okay. So, for example, a payout ratio of 40% is just telling us out of the profit the company made, 40% is going to the shareholders. Then the company is keeping 60%. Okay. That's what the dividend payout ratio is telling us. Any questions? So a company with a higher dividend payout ratio is good for investors. Okay. If, for example, let's look at two companies in the same industry. So let's say, okay, Airtel and I think MTN. You see, Airtel's payout ratio is 50% and MTN's payout ratio is 10%. Then you see that, okay, Airtel has given more of its profits to its shareholders as compared to MTN. Okay. Yes. So yeah, from the shareholders' perspective, you want a significant amount to be paid out to you, right? But from the company's perspective, The more they give you, the less they keep. Okay, so it just depends how the company is doing at that point. If the company needs money to reinvest and everything, payout ratios will be low because it has to keep the money. But the company is making profits, things are going well, then it will pay as much as it can to the shareholders. Okay. Yes. Then we've got dividend cover. How many times the earnings can cover the dividend paid? Okay, basically how many times the profit can pay out the dividends, can cover dividends. Okay. A higher dividend cover just means the profit that that company has made, it can pay dividends more times. Okay. Like for example, if we have a dividend cover of 2 times, what it means is from the company's profits, okay, it can pay its shareholders 2 times. Okay. And then the money will be finished. Right. So a higher dividend cover, it means you've got enough profit to pay dividends as much as you can. A lower dividend cover means you don't have enough profits to pay dividends as much as you can. Yes. Any questions on the dividend cover? Now remember, with the dividend cover, it doesn't mean that if it's 2 times, it means the company will pay the dividends twice. No, it is just giving a theoretical scenario that if the company had to pay its dividends, it would pay it 2 times. Okay. Yes. So it doesn't mean the company paid twice. Yes, market to book ratio. You are comparing the market price per share versus the book value per share. Remember, the book value per share, this is how much the shares were issued out as originally. Okay, the price of the share. So, for example, if ShopRite, when it's initially sold shares, the shares were at 5 kwacha per share, that is the book value. Now, the market value is dependent on how well a company is doing in the stock market. Right? Company is doing well, okay, and also the demand for its shares, market prices go up. The company is doing bad and there's less demand for its shares, market prices go down. Right? So it's basically you're just comparing its historical value, the historical value of a share versus its current value. Okay. Yes. So if this ratio is above 1, then you know the current value is greater than the historical value. Means the company is doing well. Okay. But if it's less than 1, then it means the historical value is higher than how much the current value is. That can be a bad signal. Okay. Because usually as a company, you wouldn't want your market price, the market price of the shares to be lower than what they were originally issued for. Then there's something wrong there. All right. For example, if you issued out shares originally for 5 kwacha per share, you expect in the market they should be those shares will be selling for more than 5 kwacha. But if they're selling for 4 kwacha, but you issued them out originally for 5 kwacha, then there's something wrong. Yes. Any questions, colleagues?